Hey guys, this is the Commodity Report, episode 1 million and something at this point. We've been out for a while now, Kevin. It hasn't been 1 million, but we've definitely done a lot of episodes now. We're at least up to, I saw at least 25 the other day. So we've been doing this all year long. Going
Nice.
back to January, Kevin and I started talking about oil and that breakout that happened and basically, buying call options on it. Great trade, great short term trade there. And then we've continued on this entire time calling major turning points, things to watch, talking about oil every single week, talking about the dollar and so on. So, Kevin, everybody, you've been so busy working. We appreciate you taking the time to hop on whenever you can, man. But what are you seeing in the markets now? Want to kind of like give you some time today to kind of go through what you're thinking of the markets and what you're seeing.
Well, I don't mean to neglect the commodity report. It has been busy for all of us, to
Yes.
say the least here, but we're going to try to get back on track. I do apologize. Been super stretched here. All right. What do you want to hit? Oil first?
Let's do the dollar first. Let's start
Yeah.
big picture
Okay.
macro.
Kevin's feeling like he wants to nerd out today. Let's do this. Okay, so for the dollar impact itself, I mean, obviously, we've seen a nice little consolidation pattern taking place with the dollar, and rightfully so. That 100 level has been a very key area of support here in the past, but now we're starting to kind of have a little bit of a retracement back to the upside. I think there's a couple of things that are taking place there. One, tactically, and when you're looking at positioning wise, I think you're seeing a little bit of a reversal. And then also when we start backing out the additional rate cuts that were being priced into the market by the end of the year, that also has been putting positive pressure on the dollar. When you kind of look at it traditionally, right? Usually when you cut rates because you have potentially economic weakness, you're trying to spark economic growth, and you usually see currencies move to the downside when their own central bank actually does take action to cut rates. We did cut rates, but the market was pricing in like 100 basis points by the end of this year, even 125 basis points by the end of this year. That includes the 50 basis point cuts that we've already just did. So let's say net balance, either another 50 or 75 basis points. The market has now kind of backed that out. And you could see that really within the dollar. And the dollar just reflects the strength that we have here in the United States compared to some other countries that are out there, or conglomerate of countries if you're looking at the EU itself. And so the economic data has been coming in relatively strong in some parts here. And Chairman Powell last week on Monday basically said, hey, we got 50 basis points still left on the dot plot for this year. Expect those to happen. And I'm paraphrasing, obviously. Expect those to happen. Anything more than that is going to be on the weakness of economic data. Now, we do not have a meeting in October. We have a meeting in November. It's going to be very interesting because it's going to be the day after the election. And we only have a few more prints when it comes to the labor market, when it comes to also CPI, which we will have CPI on Thursday this week, if I'm not mistaken, and then PPI on Friday, if I'm not mistaken. So there's not a lot to really kind of reverse the trend of the Fed to have maybe another 50 basis points in November, which could be on the table, and another 25 or 50 in December here. I think we're just seeing a little bit more of a retracement of that for right now. I would look at an area of resistance for the dollar index sitting at around 103.6 for an area of resistance before we try to reject and then maybe retest those 100 levels right now. Going for the remainder of this year, it might be hard to break 100. But I would say over the longer term time frame, in my opinion, we will get below 100. If the rate path and the rate cut cycle goes as the Fed expects, we should be able to get there, barring any type of crazy event that happens within China, failure of stimulus, and or a massive escalation within the Middle East that then causes a really significant spike when we're talking about crude. Right now, guys, when we're looking at the crude markets, the balance that we're seeing is something that's been on the radar. We talked about how cheap the crude oil option premiums have been. And now we kind of see that realization, right? When you have cheap premiums compared to expected or suspected risk that's in a market, you try to capitalize on that. Is that trade over and done with? Maybe, maybe not. For me, you guys know me. I'm somebody that's like trying to be very, very conservative before like trying to say, oh, 100. Like I saw already our article, I reposted it. $100 oil is coming, right? Like hold your horses, because outside of the geopolitical risk that you have right now, there's not a lot that gives crude that true fundamental bounce catalyst, especially when you have seasonality kind of coming to the downside here. Reason why I kind of go back to that dollar standpoint is that right now it seems like the Fed's going to be on the right trajectory. It doesn't look like we're going to get more than 50 basis points for the remainder of this year. I would be very shocked if we get a surprise print that's not based on the hurricanes that have been occurring too. We have to keep that in mind. We might see a bad employment print, but that also could be the result of what's happening in Asheville, what's happening in Florida, and things of that nature. So that's kind of what I'm looking at when it comes to the dollar. I'll kick it back over to you guys, Sam or Jason. What do you guys got as far as your thoughts on the dollar right now?
Yeah, I mean, for me, it's the same thing that you're looking at. Is when we're looking at the 100 level, that's going to be incredibly important. Now, once again, it's just that line in the sand that tells us, are we heading towards more deflationary kind of shocks? It's so correlated with oil today that it's going to be kind of interesting to see how that ends up. I don't think that correlation is going to stick forever, but for now, it's obviously sticking in place as a kind of safe haven risk. I mean, and Kevin, you and I have talked about this before. I always talk about the dollar as the panic currency. It's a panic currency. So once again, people are kind of panicking. You're seeing this move in oil off this bottom. Oil's bouncing, dollar's bouncing. I think like you're thinking here is where we're probably going to get under that level at some point, unless the Fed comes out and says they're not cutting rates anymore. Next chart for Sam. Sam, you made this chart the other day. It's a beautiful chart, kind of going through resistance turning into support. Right across the board, if we're looking at crude oil, heating oil, gasoline, right across the board, resistance turning to support, bouncing off those levels. What are you seeing on this chart, Sam?
Yeah, exactly like you described it, Jason. It's a polarity 101. And I also included the correlation between crude oil and the dollar. And I'm not convinced the dollar is breaking down here. Like, if the dollar is breaking down, then all of these charts are probably breaking down as well. And that's not really the bet I want to make. I want to bet on crude oil, heating oil, gasoline digging in here, bouncing. And last week they moved together. They both had their best week since it was early 2023 for crude oil, I believe, and late 2022 for the dollar, something like that. But I think they're going to keep dancing together.
Can I talk about that real quick? So there has been a direct there has been a direct correlation with the dollar. So this is not a new phenomena over the last like 2 weeks. I think there's probably a little bit more focus on it over the last couple of weeks just because of the events that have been going on. But the correlation between the dollar and crude has actually been very strong over the last 3 years. I think there's several different things that have actually taken place, right? In the past, let's bar the last 8 years, 10 years, okay? In the past, we used to have a really strong inverse relationship. A cheaper dollar, we would have higher oil prices. We have lower oil prices, typically stronger dollar. But the production mix on a global scale has changed. We're the new number one producer that is out there now. So now you kind of have it flipped. Everything is still priced on the dollar. I know that there was like this huge scare. Saudi Arabia is not going to be priced on the dollar anymore. Like the US dollar is going to collapse and the world's going to end and all this stuff. No one cares about any of that stuff. Right now, we are the number one producer. Right now, we're still going to be priced on the dollar for a very long time, unless OPEC comes out and completely undercuts and tries to take crude down to 45 or even $30, which you start eating into the major integrated players out there. They're basically their profitability levels, which depending on the player, between 25 and let's say $40, right? And you're talking about a premium player a lot higher than that, right? So I think that's probably also another reason why you're seeing that strong correlation between the US dollar and crude. I think it's just because the mix, our position within the world right now has also adjusted. And so I don't think that we should be all too surprised by that for now. Until we get the end of the cycle, until we get to the end of the rate hike cycle, and then we see what the refresh is going to be. The yen is also another one, right? That people kind of overlook. If you actually overlay the yen to crude. There's a pretty much almost an inverse correlation that's right there, right? Even though the yen outside of Japan buying barrels, no one's using the yen to be able to settle oil trades. That's just not how this thing works, right? But there is a correlation that's there. So I would just say you might be right. And in that thesis, if you don't think the dollar is breaking down, then maybe oil does not break down. We also have to keep in mind too, oil is in a very, and still is in a very precarious situation right now. If you're looking at the trend lines, where in my opinion, we were teetering on economic recession, price action, right? Or completely oversold and speculators are completely off guard. What are the two? The 200-week moving average, we're still like violating that for the most part. So I think we also are in a situation too where there's heavy net short positioning that's taking place. There hasn't been any net covering. I want to dispel that because every network that I look at, except for the one that I'm on, everybody's saying that, oh man, look at this massive short covering event that's happening because of the geopolitical risk. That is not happening right now at all. In fact, the last 3 to 4 trading sessions, there's only one day where we actually had net reduction in open interest, which would signify a short covering event. That's not taking place. So that managed money positioning is still out there. No one's getting hit yet. It was like 3,200 contracts. There's 1.6 million contracts that are sitting out there if you go across the whole curve. 3,000 ain't doing jack on a short covering type of scenario here. So I think this is just intraday pricing that's taking place, intraday volume. Last week, I believe that reversal candle, the initial reversal candle, was the largest volume that we've seen since February 2023, something crazy like that, right? All intraday volume that's being pushed in right now. You're getting some people to nibble in, but those shorts in this, the major managed money flows have not gotten squeezed yet. I don't believe that they're going to get squeezed. I got to send you this chart. I don't think they're going to get squeezed until it hits around $77.25. If you look at the anchored VWAP from the top of this year, just on a year-to-date top, from the top chart, from the top of this year all the way down, $77.25. That was on Thursday or Friday of last week. If you go year-to-date anchored VWAP all the way across, guess what that price level is? $77.25. So you take the average volume weighted price from year to date, as well as those highs converging at that level, is probably going to be your breaking point to get those shorts out. We still have a long way to go, for my opinion. And I don't think that it's sustainable enough. I'm going to undercut what we've been talking about over the last 3 weeks because, and I'm on a tangent here, but I think because I've had some people, one person that got under my skin on Twitter, because that's not that hard to do. But I had one person that was like, dude, you're super bullish on oil because of the fundamentals. And I was like, when the hell have I ever been super bullish in the near term, right? We talk tactical setups here. At least I do, right? I'm not giving you a price target. I can't even do that. I'm not giving you a price target of what it's going to be this time next year. Who cares? Things change. These are all tactical setups. So one thing to just kind of note, without anything additional with this geopolitical risk, right? I don't think you really have much to stand on here. You need this geopolitical risk, and this is going to sound really bad, but understand we're traders, and we're talking about money here. And so unfortunately, money can be made in times like this, even though it's unfortunate on both sides. If this can sustain, this type of price action can sustain until you get good data coming from China around industrial production, manufacturing PMIs, which we did see Hong Kong PMIs actually go in expansion territory. That was on Thursday of last week. And still you start seeing those numbers hit. Until you start seeing something that's really, really bright from a long-term structural standpoint from the fundamentals, this is still just a short blip. Now, when I say short blip, this is just something that's in time for right now. Markets always will price in geopolitical risk over time. Russia-Ukraine conflict is probably the worst now than it has been throughout the whole conflict, and people actually follow it, right? The worst. They're talking about a lot worse stuff than what's going on in Israel and Iran, but the market prices that in. Okay, we know that that's happening. And Israel and Iran will be the same type of scenario. You need the fundamental catalyst, gasoline demand to kind of spike up or have abnormal trends to the upside seasonally. You need to have export demand getting greater for the United States. China imports getting a little bit greater. A rebound and acceleration of consumption trends in India to be able to make this thing really super cycle it out. You got the light, you got a little bit of a flame, but don't go head over heels yet. Because honestly, all you need is, okay, ceasefire or whatever. And this thing's going to reverse like a rock if you're not going to get these guys squeezed out. I'm sorry, I took way too much time there, but I have to just make it known. If we say something on here, especially for me, it's probably a week setup, if not 2 weeks. And anything that's longer than that, I will specifically tell you that it's longer than that. I am not bullish fundamentals when it comes to crude. I am bullish fundamentals when it comes to that short position, though. I am very, as soon as that thing gets cracked, all bets are off. But you need that other catalyst. You need something that's more than just weather related and geopolitical related to give you the long-term thesis of this trend, similar to what we saw earlier this year when everybody was negative on oil. And you and I were like, hey, the positioning's there. The demand has been there. There can be something here. We have one piece of the puzzle. I think there's 3 pieces to a puzzle right now. We have one of them. You need 2 more.
Yeah, Kevin, let's talk about positioning. I'm looking at heating oil. Commercial hedgers are net long for the first time since early 2020. What does that mean to you?
Say that again?
Commercial hedgers for heating oil are net long right now for the first time since early 2020.
Yeah. So
just
let me
before COVID.
Yeah. So let me get this real straight. Commercial, can we do a quick breakdown, commercial and non-commercial? So I may have I should actually clarify my statement to make sure people are clear. When I'm talking about net positioning, net long, okay? So net long positioning, when you're looking at non-commercial means managed money. Non-commercial means the retail trader like yourself and myself. And actually there's a further breakdown. Non-commercial, non-reportable is going to be more like the guys like yourself and myself. You know, if we're trading a 1 lot, 10 lot, whatever, but we're not trading mass size. You have commercials. The commercial players that are out there are the ones that are actually hedging physical supply, okay? The commercials is going to tell you where to go. But here's the thing, it's opposite. When commercials are shorting their product, whatever product it is, crude, they're locking in prices for their physical longs, right? The physical inventory. If they're going long a product, that doesn't automatically mean that they're actually long the physical. They might be also long a product because they might have a failure to deliver type of scenario. They might have other derivatives products on the longer end of the curve that they got to be able to hedge. But you want to see commercials actually net shorting products. You want to see them produce more, short more in the futures contracts because they're trying to lock in price. You really don't want to see them going long too much because that's probably a signal that they're soaking up the shorts. So the price of that action should be to the downside until you get to a point. And here's the point that Jason and I love to see. It's the pivot. The pivot of those positions is when you get the opportunities for price action to spike. It's not that, okay, dealers continue to go long and they continue to go long and they continue to go long and prices are going lower. That's not helping them. Most likely, they're probably offsetting another derivatives product that's in their book. They don't automatically just go out to the futures market. They got off-exchange swaps that they can take take place. They have maybe physical demand. When I say physical demand, they may actually have maybe physical delivery that they have to make of a product, what have you, that they might not be able to source. They might buy the future. They might have somebody else actually physically deliver it and swap out products. But the pivot, when you start seeing those commercials, when you think about commercials, think about producers, those that have actual physical, start to reverse. And that long starts to peak out and we call it cutting down positions, right? They start to cut down their positions a little bit more. And then all of a sudden, boom, they're going net short. Is that, those are commercials, right? On that
Commercials
screen.
in green. Yeah.
Okay.
Yeah.
Commercials in green. If you look at commercials in green compared to commercials that are going to be as their positions go down, you generally will see prices going up. Those commercials started spiking up 2008. You see it, there was like a little bit of a lull. You see the commercial buying started to increase. What happened to price? Went down, right? They knew exactly what's happening, right? They got to cover. You can look at it for COVID-19, same thing. Producers started ramping up their purchases before the equity markets actually dropped off, before heating oil actually dropped off a cliff.
Yeah,
These
that's what's
guys
really
know.
interesting is it happened like in February,
They
and
know.
then it just had a quick whoosh moment, and then it bottomed in May, and then it
They
had a
know.
historic rally.
They
So,
know.
like, maybe that's the scenario here is we get a quick whoosh through this former resistance level that we're trying to turn into support. We
Yeah.
fail to break down, and then we rip it higher.
Yeah, that might be the case. I always, so I talk about, and there's other places that you can get this. The commitment of traders. There's a CME product that's out there. Not a product, but they have a decent platform. Bar Charts has a good platform. I'm not going to say All Star Charts doesn't. They might. What have you. What I will say though is you follow whatever the producers are doing. If producers are ramping up shorts, that's ultimately bullish. If they have to have a hedge to the upside because prices continue, they're trying to lock in higher prices, right? They're increasing shorts, they're trying to lock in price. If they're not increasing shorts, they're not trying to lock in prices. They're probably unwinding positions. So, but I think there's a correlation there. I went on a complete tangent, my bad. But look, heating oil seasonally has actually a really good setup. And that's going to be the indicator for me. And then unfortunately, heating oil has been a dog this whole year. And those individuals continue to short it. Actually, I believe that there was a net long position this week. But if you have like a 3-year weekly chart, we're literally at that downtrend right now. The downtrend from the September 2023. Yeah, you're sitting at around 230 and some change. I will look at 270 as being your area of resistance right now. What do you guys think, though?
No, I agree. I mean, I think number one, when I always talk about COT reports, if you back test them and you understand, and you back tested them as well, Kevin, if you understand what so many people, they'll see like Palladium for the last couple of years. Palladium has been in a all-time record-breaking commercial buying for a year. Now it's finally starting to move. And the reason why is that so many people get so interested in this. It's why it's hard to create systems, because people want to just create a level and go, okay, here's the level for the COT report. Therefore, this is how it's going to go. But it's just not that. So if you look at the heating oil, for example, we're at this extreme level in commercial buying. When we start to see that, as Kevin's talking about, when we start to see that turn down, that's usually the signal. We start to see the covering and so on. At the moment, we're not seeing that just yet, but we are seeing a bounce. That can change quickly. Now, once again, it's like they understand things. And also when the market is under pressure, they're going to come in and start buying. And also we want to be on the side of these people at certain times. And we also want to understand that when something is trending, you don't want to be on the side of it. It's kind of like gold. Gold's been in an extreme commercial sell signal for weeks, months. And so that's been in a commercial selling signal for months. And if we look at that, we would go, okay, well, do we just sell all our gold and run for the hills? Like, does that make sense? And the answer is no. You have to have the right environment. So once again, if I would see the commercials turn down here and get to extremes on the other side, I wouldn't sell my positions in heating oil, let's say, until I actually saw the market trend change, or a news failure event is something that Shapiro uses, or you could use a trend model, whatever it is. You have to figure out certain things. But for me, I do like this setup here. I will say there are some things in the way to make me go, okay, energy could go higher here. But like Kevin said, I'm not extremely bullish on it. I'm more longer term. Kevin can make hits on a week-to-week basis for me, and that's amazing. It's very hard to do that. For me, I have to go on a little bit longer term. And thinking about the longer term trend, I do think that, one, we can't get too bullish on energy here. The reason for me, Kevin has the fundamental reasons. I have the technical reasons, which is just in a downtrend still. I do like the idea of, hey, we're trading for a bounce here. Hey, there's a false breakdown signal. And also going into year end, we're kind of getting into a very bullish zone for some of the energy sectors. We're also seeing all-time highs in a couple of the energy stocks. There's some things to be bullish about here, but you have to still be cautious. We aren't in a perfect uptrend here. So I think once again, it's a sit on your hands type of situation. Wait for this trend to change, and then it'll be the easiest trade. But I think trading for a bounce here, trading for a reversal signal here, I think it's a great idea for something like that until we're seeing what Kevin's saying. And we're not, and I agree with Kevin. It's been all over everything about this short selling crap. And that's part of the thing I hate about, most of the media sources, is that you have so much media out there that just lies to people. They just make up stuff, whatever it is. Like, they don't know what, Kevin and I have looked at the COT report for God knows how long and understand how they work in a way that most people don't. And also we have videos. I'll share the video in the chat on YouTube that Kevin kind of goes through all of his system strategies and where he gets his information from. So you guys can do that as well. But that's what we do here. We try to teach you how to do it for yourself. It's not a recommendation. It's not how to trade. It's how do we teach you how to do this for yourself? Look at these things for yourself. And that's really going to teach you how to be a good trader. These people that come out here and lie to you about short covering that's not happening or something, like, you're not going to learn anything from that. You're just going to listen to somebody say something, think that's how people like us get our information. But what we're telling you today is we get our information from actually the information. We don't get it from any news sources. So I love this. It's another one of Sam's charts. A great chart, Sam.
Can I add on to that real quick too?
Please.
The people that manage money.
Yes.
Those are another one.
Yes.
And I'm not hating on people. Look, I don't hate on anybody's hustle. I'll be the first. I've been hustling all my darn life. I ain't gonna hate on nobody's hustle. But what I find very funny is that in July, cruise hitting $83 and let's say 30 cents, 40 cents. And I can scroll through every single financial news network and every single one of those portfolio managers. We're long crude. We're long oil. We can see oil going to $100. We can have $120. They'll even throw AI in there. Oil's going to go up because of AI. Like, however that even works. Cool. All right. Right. Cool. And then you're like, all right. And then people continue to say it week over week. And that price action is just going lower and lower and lower and lower. And it's like, what happened to all that enthusiasm? What happened to your position? Because if you some of these guys manage billions of dollars, where is it? Where's your position? Or are you just talking? Because I don't see you bullish on everybody and their mother's bullish. That should be enough to drive crude up if you actually had dollars to work. A lot of them don't. They just say that whatever they have, and then they kind of go and then and then 2 weeks ago, well, we're bearish energy. I'm sure you are.
Yeah,
I'm sure you are bearish energy. As this the whole thing. I mean, we've been talking about the setup for a long time here. What Josh Young, when we had Josh Young on, you guys can go back and even check. Actually, it was probably the week before that, 2 weeks before that. We had a gap there. You can go, you can go back and check. But there's also the same, hey, premium risk, cheap at that time. Hey, it's a little expensive now. You're talking about $1.20 and at the money crude options that are expiring tomorrow. That's expensive now.
That's expensive.
And then trade, if you're gonna have exposure, this is gonna be the downfall of a lot of people, in my opinion. And I'll give you guys a little bit of heads up. Not a recommendation, but a heads up. And this is going to go counter to probably what I know Sam's always got some charts up there to be like, but check this chart out though. And I got to give him kudos to that. If you're going to trade energy right now, get exposure to the direct contract as much as possible. Be very cautious on proxies right now. Be very cautious on the Chevrons. Be very cautious on the Exxons. Be very cautious on the Oxys. Everybody and their mother right now is an Oxy petroleum bull. for whatever reason.
I have no
For
idea
whatever
what that's
reason.
about, and
It's the
nobody
chart
like.
setup. It's
Ye-
the chart setup,
but I
it's
wouldn't
still,
say that one even has one.
it had a pretty decent chart setup, but you're talking about a company that's highly levered compared to any of its peers, makes a lot less money. Right now, still trying to kind of get rid of its midstream business, which is refining, right? And distribution if you subscribe to John. I know.
But
I know.
my face was for looking at the Oxy chart.
I know. I know you're gonna say that here. I know you're gonna say that, but it pays a 2.5% dividend, lower margin levels than any of the integrateds that are out there, any of its peers, high debt levels, still trying to restructure. Why? And in its exploration, like pure exploration play for the most part, right? It's getting rid of midstream. Why? Because Warren Buffett continues to nibble in, where you have a lot more different opportunities there. The reason why I say that is the margins, the 3-2-1 crack spread has completely done nothing. Last week, we had a nice little rally when it came to diesel, crude oil, heating oil, this, that, and the other. Everybody had a good rally. But if you look at the 3-2-1 crack spread, it hadn't budged. I wrote this morning. I still got to put it out. A 0.6% increase in the 3-2-1 crack spread. Is that good for margins? You had what, an 8% to 10% move in crude? And the profitability of between all those products still net to be, for the most part, the same before this run. That's profitability for these energy companies. And when they start to report here, and they're going to pre-announce probably another week or two, when they re-announce and you look at XLE and you look at the Chevrons of the world, and you look at the Exxons of the world, or even if you look at the Valeros of the world, and you see the equity valuations continue to go up, but their marginability on the 3-2-1 crack spreads going completely the other way, a massive divergence, a divergence I haven't seen since 2013. Tread lightly. Follow the herd when you can. But there, I believe that there's probably going to be a massive re-rating, in my opinion, when it comes to guidance expectations for a lot of these energy companies. So if you want to play, trade crude. If you don't like the big contract, trade the mini. You don't like the mini, trade the micro. Don't want to trade futures at all? Cool. Trade USO if you have to. Be careful, right? USO, you're going to need to actually kind of finesse that a little bit. Buy time, sell calls against it, because the premiums are so outsized. That's my biggest thing. Everybody and their mother loves energy exposure right now, but if you're looking at it just from fundamentals, they're not going to be that profitable. Their margins are going to be squeezed to all hell. Their margins, that 3-2-1 crack spread has decreased by like 60% for the quarter alone. What are you going to do? Trade the
But
price.
isn't the market like a forward-looking mechanism? You know, like these
Let me
crack
bring
spreads
up
have
the chart.
already been whacked. What if it's been enough?
That's a good question. I'm going to send you a chart. I do have a hard out in like 10 minutes. Let me send you a chart. I'm going to get you one. That is a good question. Look, demand, there's this whole thought process of, there's a forward pricing mechanism when it comes to equities. And I get that, right? I get that. Your forward pricing indicator for energy companies is the crack spreads. And there's like 20 different ones out there. It shows you the potential marginability. When we say that, let's say profitability, and it's really crude to say a lack of a better term. But if that crack spread goes lower, margins for those companies go lower. I could care less how much you're trying to forecast and forward price. But if the market right now is telling you that their probability is going to be bad, how can they have a forward guidance that's going to be better than what we can actually price on the curve? I'm going to give you a chart. I will give you a chart of XLE. I'll try to do it as far as I can go. I'll try to flip it to you really quick here, Jason.
I can get it. What XLE?
And then I'm going to do the 3-2-1 crack spread. I actually have an indicator that's already built in for it.
Okay, go ahead.
Because that is the indicator. I understand that there's a forward pricing mechanism that is in place. By all means, right? I am a student of that.
So I think one thing that's kind of interesting to think about here is, one, I'm always going to be the guy who goes with the breakout. It's something to me that makes a lot of sense. Oxy, some of these names like I wouldn't touch, but if you're looking at the XLE and you're going, hey, you know, ExxonMobil is 22% of the XLE, ExxonMobil's breaking out. You know, it's something that does make sense. However, your one part about playing the actual physical products, I always do agree with. It's not that I don't think that energy can go higher here. I think that's very possible. I think it's probable. It's that the outperformance will probably be in the actual products, like Kevin's talking about, the actual products of crude oil, gasoline, heating oil, looking at those products and then making sense of that. I think that's probably one of the most important things Kevin and I talk about all the time on here. But yeah, no, did you send the chart, Kevin?
Yeah, I'm going to send it to you. The label is wrong. It's 20-year chart. I just sent it to you. It's a 20-year chart. It's going to say 10-year. But it's a 20-year chart. This has the XLE, and it has, this goes back, let's say that crack spread goes out to 2005. Okay. And when you kind of notice the rapid declines or spikes kind of leads to, when we're using and XLE is not a great proxy, but it's usually what people utilize, right?
Yeah.
What I was kind of going towards,
pull it up like that. Yeah, I'll just pull it up like that.
Okay, so what I'm actually looking for, so this is what we are seeing, right? So that red line is showing you 3 barrels of crude oil creating 2 barrels of gasoline and then 1 barrel of heating oil, diesel, whatever you want to call it, right? There's other ones that are out there. Actually, the CME site has a crack spread calculator for all of these different blends that are out there, right? Like 10 different blends that you can use this calculator on. But this is the most popular that we usually use. All right. And so you kind of see these rapid kind of like moves to the downside, and equities kind of move higher, right? See 3 months, 6 months, then massive re-rating down. Same to the upside. Crack spreads usually will lead this market. As we start seeing that kind of go up, 2007, 2008, crack spreads started moving up. January 15, 2007. Energy prices, XLE, had a decent little run. We peaked out. Energy prices continue to move lower. Crack spread dropped dramatically, right? Look at that re-rating. Have you ever seen that much of a divergence on the right-hand side, which is what I have, of those equities moving up and the massive re-rating to the downside that you see for that crack spread? You're talking about, at that time, $60 that profitability was being priced in. You're talking about 2x, 3x costs for a lot of these energy companies. And that's where they're rightfully so. Valuation should be high. But you have a complete collapse of that. And even this year, back in July, that crack spread was sitting at around $25 $25 a spread, right? You're seeing that at around $16 now. That's a $9, $10 reduction. That's a lot of money. That's a lot of money. If you're talking about millions, hundreds of thousands of barrels of oil that you create every year. I haven't seen that much of a divergence unless you go kind of in the middle of that chart. 2013, we see a massive re-rating down for that crack spread. You saw equity values going higher. This was the OPEC boom, but this is the shale bust. OPEC increase, shale bust, margins move to the upside or move to the downside. Equities continue to rise until everybody's like, oh crap, we're not making any money. We got to re-rate this. We got, our assets, we're going to leverage our overseas assets way too much because they are profitable. But here in the United States, Permian assets weren't doing diddly squat, right? So that's my concern. Now, maybe it is a forward pricing mechanism. I haven't seen it before, but I can tell you, I don't care what this chart really shows you. I see a divergence of massive proportions on this. And one thing has to re-rate over the other. Now, do I think energy companies have enough power to re-rate physical commodities? Hell no. That's not how this game works. So I think it's going to be the other.
So no, that's awesome. I love that. Like, number one, as we have too much agreement on this show.
Yeah,
we got to figure out. Like, it's about time to have some disagreement because it's literally what we do in markets. Not everybody's going to have the same viewpoint, and also, like, Kevin or myself, like, we have no problem getting on here and being like, yeah, that call went bad. Like, you're gonna make one out, like one of the calls are gonna be bad from time to time. Nobody's gonna get everything perfect. But the best thing you can do is figure out, like, what's your methodology. Kevin likes to look at the crack spread, understand how it moves with that market, seeing where the market's going to go after that. That's how you do it. You figure out what your methodology is, you figure it out, and then you go with that. I use a lot of breakouts. If you see XOM hitting all-time highs after a nice band squeeze that's been going on for months and months and months, I'm going to buy that probably no matter what every single time. It's just however you trade and however you do this, it's really important to figure out. There is no best way. I wish there was a best way and I could just tell you the best way, but it's all going to be different for everybody.
Don't be the last. That's all I say.
Don't be the last of the trade. And
you can make the trade by all means.
Try to be the first either.
Yep. The trade has been working.
Mm-hmm.
Don't fade that. I'm just saying we have something that will be coming up here. It's on the calendar. It's not like it's unforeseen. You have something on the calendar where it is trading at a premium, a lot of these companies, and they've already told you chemical spreads have been god awful. They've been telling you that for the last 9 months, almost 12 months, right? The only thing that was really holding them up was gasoline. That was it. And heavy crude. That's sliding. So my thing is play it, but if you wanted understand the risk. And this thing could re-rate really quickly here. Hey, I got a jet. Can I bring up just one more thing? You got another chart? You got another chart?
I mean, I have more of Sam's charts, yeah, but
I was gonna throw a chart. Throw a Sam chart up there. Let's see what it is.
So let's see. What do we got? Sam, which one? Do you have anyone specifically you think we should run?
You pick one, Jason.
All right.
Let's throw it out there.
I guess Kevin is the perfect. I'm writing on this right now. Kevin, you're the guy to have this conversation with. Why is crude? I won't even taint you with what I'm writing about, but why is crude oil so correlated with the dollar at the moment?
Oh no, I like I was saying earlier, I think it's the fact that we actually do produce a lot more now, right? We're the number one producer in the world. So the drill baby drill has been happening for the last 4 years, and it might, for the most part, continue to do so unless prices crack.
Wait, Kevin, that's impossible under Biden. Like he said that wouldn't happen.
Completely, he's gonna destroy the energy markets in general. They're gonna collapse, and I'm gonna make it work by drilling more, and then somehow energy companies are going to want to spend more money when prices are lower, because who knows about economics. But all jokes aside, we have more power when it comes to the oil trade for right now, and I think that's one reason. And then two, it is a big settling mechanism. And until we either lose more power when it comes to the amount of production, right? If we have a massive ramp up from OPEC and they start to begin to flood the market a little bit more, we will have a price war. And if that price war comes at the expense of the Permian players, then we might see a little bit more of a disconnect. But for now, wherever the U.S. dollar, wherever crude goes, U.S. dollar goes. I'll even give you a bonus one. You guys want a bonus one right now?
Yeah.
Wherever crude goes, U.S. dollar goes. Wherever yields go, crude goes.
Mm-hmm.
Look at that correlation. Actually, it's a lot stronger than
the highest correlation, and that's what I keep getting to on my post. Is that's the highest correlation. That's yields, real yields, like however you want to look at it. Real yields, not as much, but just look at the 10-year yield and crude oil, and you can see where it's ending up. And Kevin, real fast, I don't know if you have a sec.
Yeah, I got like 2 minutes.
Okay, so. You brought up earlier, and feel free to drop off if you have to, or just cut me off and say you got to go. But the one thing that you brought up earlier that I thought was interesting, and this is Sam would have been not even a baby at the point of some of these things happening. If we're looking at 2001, we're looking at like you mentioned the dollar and the strength of the dollar, and the dollar is really backed by the world's belief in the dollar. Our military industrial complex, all of these things. And it's kind of interesting what you said earlier, but you didn't go in depth into it, which is when we were talking about 2001 and what happened to crude oil and the dollar. And if we look at, something that happened in Africa, in Libya, we also had the situation where we kind of went in and we're like, oh, you guys want to make gold the thing you're going to trade oil in Libya. And that ended up changing, us kind of going in there and being like, okay, we're not doing that. So over the years, we've had a couple threats on the dollar, one being to sell our golds in euros, another, or our oil in euros that was coming out of Iraq. And then gold, they were going to sell oil for gold in Libya. So Kevin, do you have any thoughts on if there's any type of risk like that out there right now?
No. Look, everybody's
I don't
talking
think
about this whole
anybody's
gold
challenging
thing.
us, but do you think
Yeah,
anything could come up
no.
like that?
No. I mean, it's war. You're being very really too nice. It's all about the military arms that we have and the allegiance and the pacts and alliances that we have around the world. That's what makes the dollar go round. That's it. And the fact that we are able to extend credit and consume as consumers here in the United States, and we have no problem with going into massive amounts of debt, each and every one of us, to be able to consume and have experiences where no other country has the benefit of the doubt of that. And until people actually stop buying our treasuries, that's going to continue. It's always going to be a concern, like it was in the 70s, like it was in the 80s, like it was in the 90s, 2000s, 2010s, where it is right now. Oh my God, the debt. Got it, dude. As long as we can issue and people are buying, we're going to continue to consume as much as we possibly can. And that's going to be the number one thing for me. What I will also say, if you think that there is any type of gold standard out there that can be maintained for any physical commodity, you're out of your mind. And there was no way that you were going to be able to lift up massive amounts of society with a limited and finite amount of whatever currency or bartering system that you want to have. That is why we saw the rapid expansion. People were pissed off about the gold standard going to the wayside, but that rapid expansion of credit and availability has lifted up millions and millions of individuals here in the United States and around the world. And if you want to constrain supply and you want to be able to utilize gold for your only use for commodity trading, that is how you create massive oligarchs and massive dispersions when it comes to wealth. Wealth will be centralized. It's not something that is scalable at all. Not something scalable at all. People get pissed off about what the system is right now, and we can all be pissed off. And as we're watching our TVs and watching YouTube on our TVs and getting our iPhone 16s and all that stuff, none of that stuff would have been possible under a gold standard. I'm going to keep it like that. I do have to jet. Crude oil right now is above $77.10. Crude oil may reach that resistance level that I brought up, $77.25, 27 cents. I'm looking for a sharp reaction after. I also have to keep our eye on the news wire here because something is causing this thing to massively rip. And if you guys ever have a chance, correlate crude oil and the 10-year treasury over the last 5 days, look at the price action. It's all the same.
Always.
I appreciate y'all.
All right. Thanks, Kevin.
I'll be on the Friday show, dude. I'll be on the
man.
Friday show, man.
Yep.
Yeah,
I'll see you soon, man. Yep. We'll see you guys soon. And just to add on to what Kevin was saying, the debt has been a problem and a fear since the beginning of basically since the 70s. That has been the big thing, the big fear. We have so much debt in our system, it's going to be the end of it. If you still watch today on Twitter, you'll see a lot of guys continue to still talk about the amount of debt. I'm not saying it's good. I don't have the same belief as Kevin in the gold standard and so on, but I do have the idea that debt. If we're traders, I don't care what's going on with the gold. I don't care what it's doing to society. I do care what it's doing to the market as a trader. And granted, I'm not a person who hates people and I don't want to kill people. I don't want people to be upset or hurting. I'm just saying, for the purposes of the show or what I do at Against All Odds Research on Substack, I want to make sure people understand where this market can go, where it could end up. And a lot of the time, that cycle is driven by debt. You got anything to end on, Sam?
Yeah, if you're worried about debt, you probably don't want to bet on lower interest rates.
Yeah. Good point.
Yeah.
All right, guys. Sam and I have the Gold Rush show at All Star Charts. I know some of you guys are Gold Rush subscribers, so we'll be filming that pretty soon, and that'll get sent out to you guys right away. All right, Sam. I'll see you in a few minutes.
Yeah, half an hour.
All right, guys. Bye.